PR Hari joins us now. Let's take our conversation forward to understand from him that how things have transpired for the company for the quarter gone by, and for GRSE how things could look up, at least in terms of both the recent order book and the execution of that order book. Good morning, Mr. Hari. Thank you for joining us. Now, margins for the quarter gone by disappointed. Was it largely because of some base effect? Was it largely because of the steep increase in commodity prices?
Thank you, Nikunj. Before I come to the margins, the year gone by has been good for us. We just announced our financial results yesterday. This, in our perception, has been the best in terms of financial performance, with the revenue from operations and the total income going by nearly 45%, and the PAT going up from 189 crores to 228 crores. That is an increase of 20%. Now coming to the margins. The margins, the PAT margin, we are still maintaining 8.26%. And the EBITDA margin, the year on year, that is for the FI, when we compare FI 22 to 23, we are currently at 11.7%. Yes, in shipbuilding, maintaining very high margins is not a norm. In a shipbuilding scenario, anything above 7 to 7.5% is good. And as I've been consistently maintaining and discussing over the last few interactions that we have had over the last 1 year, that we are and we will maintain a margin beyond this 7 to 7.5%. And as on date, as I mentioned, our PAT margin is 8.26. Coming to the order book, as on 31st March 2023, our order book is a healthy 25,111 crores. And that comprises of 6 projects, that is 4 for the Indian Navy, 1 for the government of Bangladesh, and 1 for the government of West Bengal. Now coming to the naval projects, the 4 naval projects, one of course is the prestigious P-17 Alpha stealth freight project for 3 warships, and a 4-vessel survey vessel large project, 8-ship anti-submarine shallow water craft project, and 1 new project that have added to our order book, that is the 4 next generation ocean going patrol vessels. This order value is approximately 3,500 crores. Now coming to the order book execution, the current order book of this 25,000 odd crores that I just mentioned will finish as per the project execution strategy by FY29. This is including the new project that we have taken on, that is the next generation ocean-going patrol vessel. The survey vessel large project, we will be starting delivery of the ship from the current year. The first ship of the project is presently undergoing trials, with the second ship close by. The 2 survey vessel ships we plan to deliver during the current financial year, and the next 2 during the next financial year. As far as the P-17 Alpha project is concerned, delivery of the first vessel will start during mid-2025, and the third ship we plan to deliver during FY27. And the anti-submarine shallow water craft ships, the first of the ship we intend delivering during the current financial year, and the balance ships will follow thereafter, 2 per year. And this project we plan to complete by 2026.
Okay, so those are all the projects. I just want to reconfirm, you said that we will continue to maintain margins above 7 to 7.5%. You're talking about your EBITDA margins or your PAT margins, and what is going to drive that growth?
Thank you, Aisha. I mentioned PAT margins. That means I mentioned that we'll be maintaining PAT margins above 7 to 7.5%. And as of now, our PAT is 228, our total income is 2,763, so it comes to 8.26%.
Trajectory when it comes to your EBITDA margins, because this quarter, just looking at the quarter, not the full year, I know you flagged that off, it's at about 3.3%. So will you recover from this current level?
See, what has been done, whoever has calculated has taken off our other income from that. As far as we are concerned, other income is arising out of our working capital. When our working capital is wisely and effectively managed by the treasury, that naturally generates other income. So if you add the other income, it is not 3.3%, it is about 6.8 to 7%.
Every operation, I mean, what markets want to know that operationally, what margins would you make?
Working capital is used for, it's not surplus money. It is actually a working capital. So that in effect is translating into operations. Any which way, year on year, that is, if you're considering, especially in shipbuilding, it would be prudent to compare performance over a year because the shipbuilding projects normally range from 4 to 6 years. So if you're comparing quarter to quarter, there could be deviations depending upon the project execution stage. So it'd be prudent that we compare financial performance year on year. So that's why I started off with the FY 22 and 23 comparison.
Also tell us, Commodore, as to what have been the key revenue and profit drivers for you, and are you worried that a sudden spike in raw material prices like steel, energy, etc., could impact profitability going forward at all?
Unlikely. I will just give you in a nutshell. In shipbuilding, approximately 65% of an order value comes out of the material, and within this material, they at least 60% comprise, 60 to 70% comprise of major equipment. These contracts already been signed. Now the balance, a minuscule amount, an overall project cost, it comes to around 5 to 7% is the steel. Now we have a running memorandum of understanding with one of the other PSUs, the SAIL, where the prices are predetermined. Now there could be deviations based on the global steel index, and these impact is minimal because, as I mentioned, the overall value of steel in a project just comes to around 5%. As far as the equipment are concerned, we are not envisaging any kind of issues because the contracts have already been signed with the respective OEMs. One more aspect I would love that I'm given an opportunity, I'd like to bring out that we keep stating that our USPs are product diversity. And we have products ranging from warships to commercial ships to ship repairs and also deck machinery. Yesterday, we concluded a contract with Indian Navy for manufacturing of 30 guns. This order value is approximately 250 crores. And this perhaps is the first time that a warship builder is venturing into weapon production.
Now you're starting the year with an order book of 25,000 crore approximately. Now our understanding, like you rightly said, that shipping is a long haul, long capex execution cycle, 3 to 5 years, 5 to 7 years. So when you're getting an order of a ship, are you booking them on completion basis, or the order book is booked at upfront and then execution takes time?
Order book is, I'll give you one example. Now, project value of, let us say, 5,000 crores executed over a period of 4 years. Depending upon the physical progress of construction, as the ship is built and the equipment get lowered, based on the input, that translates into physical progress of construction, the order value is booked. Which means, in a span of 4 years, this value of 5,000 crores get executed and booked. Now again, in shipbuilding, the initial first year, the first phase of shipbuilding is a preparatory phase where mostly the design activities get carried out. And the next phase is the hull construction, where the ship form is formed. And thereafter, the equipment get lowered in. And as I mentioned, equipment carry a large chunk of the order value. So it is when a ship reaches a physical progress of construction percentage between 40 to 60, where the maximum revenue is recognized.
Just to understand it, and I'm glad we're having a long discussion on this. 25,000 crore order book, what you currently have, you're starting the year with. As of today, you're saying that in 3 to 4 years, this 25,000 crore will be executed.
Not 3 to 4 years. I mentioned FY 29, including the new order that we have got for approximately 3,500 crores. So now we are in May 2023. So over the next 6 years, we'll be executing this order, which means the 25,000 that we have will get consumed, the revenue will get recognized over the next 6 years.
And in terms of getting the new business line which you just talked about when you're diversifying outside the shipbuilding, what is your potential upside from the diversification when you're moving into weapon manufacturing for FY24, FY25 and FY26? Because I'm assuming unlike ships, guns can be made in less than 1 year, right? I mean, I'm just taking a guess here.
This is being developed indigenously for the first time. Hitherto, these guns were being imported. So the development time will be there, but you're more or less right. These could be developed and delivered within a span of, let us say, a year to year and a half. So we intend completing this project and recognizing this revenue of around 2,000 crores, 250 crores that I mentioned over the next 1 to 1.5 years. And also, what is more important is that while this is just 250 crores, it also gives us a window of opportunity to enter into this area of business. We have already, as a diversified company, perhaps the only one of its kind in India. In addition to shipbuilding, we also have verticals which range from portable steel bridges, where we almost own around 65 to 70% of the Indian market. And also we have a deck machinery division and the diesel engine division. So this gun manufacturing is another area that we have just opened up.
Appreciate those clarifications, appreciate the outlook on the business and where you see things headed. Time for a very short